Africa's first Debt for Nature swap, which will fund marine conservation in Gabon, has backers hoping for more such money-saving environmental deals. But some say there's room for improvement in the increasingly popular transactions. First, let's look at what they are. At their simplest, Debt for Nature swaps see a country's debt bought up by a bank or specialist investor and replaced with cheaper loans. A development finance credit guarantee or risk insurance helps bring the cost down. The savings are meant to fund conservation. Gabon, whose beaches and coastal waters are home to the world's largest population of endangered leatherback turtles, has switched $436 million of its international bonds to a new $500 million blue bond. It has a lower interest rate and longer maturity. That's expected to generate $163 million for marine conservation projects over the next 15 years. Gabon's President Ali Bongo has said the swap is an important moment for eco-friendly finance deals in Africa. Too often, talks of these new mechanisms remain just that, he said in a statement. But in this case, we have made it a reality. Bankers have said a handful of other African countries are also working on debt for nature deals, along with Sri Lanka and a clutch of Caribbean and Indian Ocean islands. US non-profit The Nature Conservancy advised Gabon's government on its deal. Head of Sustainable Debt Slav Gachev said the organization expects to do between 1 and 3 deals per year until 2030. Though he would not name any countries, he said eco-friendly swaps the Nature Conservancy advises on could total $10 billion by the end of the decade. But there are question marks over how Gabon's conservation promises will be enforced, says Andrew Stanners, investment director at Aberdeen. The emerging market investor holds some of Gabon's current bonds. Stanners said the Debt for Nature deal is brilliant from a fiscal point of view. The new bond comes with just over 6% interest, much cheaper than the 9 to 10.5% yield other bonds have been trading at. The US Development Finance Corporation has provided risk insurance. That's resulted in an AA2 investment-grade credit rating from Moody's for the blue bond, a full 14 notches above the Gabonese government's own junk CAA1 grade. But Stanners also questioned how the insurance would work if Gabon did one day default. Gregory Smith, a fund manager at M&G Investments, queried why Gabon Swap had seen just $95 million bought back from a bond that needs refinancing in 2025. That's compared to $405 million of its two 2031 maturing bonds. The transaction had offered the chance to eliminate this debt risk, he wrote on the Bond Vigilantes blog. But the risk remains.